The Agent David O Show.
All right, welcome to the Agent David O Show. Today we got a really special guest. We got a lender that I've used personally and known for many years. It's Holly Niemeyer with Nexa Mortgage. Holly, welcome to the show.
Thanks for having me.
Yeah, so I'm excited to kind of pick your brain today on investing in the loans and the finances part of this business that so many people have questions about. But to get us going, tell us a little bit about yourself and how you got into this business.
Yes. So I've been in the business 21 years or so. I started in the business back in the subprime US Bank, just doing loans, all the loans that shouldn't have been written years ago, doing those loans. Worked there for a few years. Then got out in 2008, took a little break, got in the music business, toured with some bands, had some fun for some years, and got back in the business about, I would say maybe 12 years ago. I got back in, I was at Caliber Home Loans, retail, doing all kinds of loans, not just investor loans, but, Fannie, Freddie, primary purchases. Then I came over to Nexa Lending, previously Nexa Mortgage, kind of interchangeably used. Came over about, let's see, 2.5 years ago. Came over and a coworker of mine, the one that brought me over to Nexa, had a bunch of investors calling her and she needed help. So she started reaching out to me saying, hey, call these people back. They need help with loans. So I kind of got just thrown in the fire of learning the investor world, learning DSCR loans, learning rehab loans, fix and flip loans. Because I had investors calling me and I had to have a solution for them and be able to help them. So I dove head first in, learned everything about investors, what they're looking for, what type of loans they needed. I work for a company that has about 250 lenders. So we had all the lenders that we needed. It was a matter of going through, finding out what lenders did what types of loans, which ones are good for investors, learning all the guidelines, all the products, everything about what they need. Any problem that anyone's ever run into, I've run into it. So I kind of dove head first and just really became an expert with investors and fell in love working with investors. I like the strategic, planning of it because every investor is different. Some are trying to buy one property, some are trying to buy a few hundred a year. Some are wanting loans, some want to pay cash, do refinances, single loans, portfolio loans. So that's kind of how I got started in the investor world.
That's awesome. Yeah, and I love what you said about working with investors and the repeat buying, because one of the things I experienced on the agent side was like people are moving less and less, especially if you've got their primary with a low interest rate or something like that. Yeah, I think the numbers say like every 12.8 years people are moving now, and so that's 12 years that I have to wait before I can get a commission, the opportunity to get a commission again. And same thing with getting paid to lend on their houses. Whereas investors, we have many clients that buy multiple properties a year. So that results in more income for us. And it's a really good relationship to have as a lender or an agent to be working with those investors.
Yeah, that's definitely was a thing for me, primaries, yeah, several years, and then they may or may not call you back if they find your information or remember it.
Right.
And a lot, I like this because you continue these relationships. I've been working with some of these investors every month. They're buying properties every few months, for the last couple of years, and I can be a part of their journey and help them scale and teach them. And it's really awesome to see them go from, from their first property to their 100th property, and knowing that I was able to help them get to that point and help them organize everything and make sure they're in the right loans for what they're trying to do.
Yeah, that's awesome. Well, yeah, I love that you put first property or 100th property. So let's focus on maybe the person that's looking to buy their first property. What kind of advice do you give them around the financing of this? Is there any certain strategy that they should try to follow or type of loan that they should go after to acquire this first property?
Yep. So most investors, honestly, I don't know what half the investors I do for a job because we don't worry about any income. So I would suggest a DSCR loan, which is debt service coverage ratio, meaning that as long as your mortgage payment is covered by the incoming rent, that's really what qualifies you. You have to meet certain credit requirements and have 20% down. but it's very minimal for somebody that may not have a history, they may not have that makes enough money to cover that, or whatever it may be. So I would suggest a DSCR loan. And there's a little bit more when you're a first-time home buyer. There's some minimums on loan amounts and different things that we have to verify. Typically, your rental history. We can also do it if you're rent-free. A lot of these first-time investors may not even own a home, so they're a first-time home buyer as well. And so we definitely have products for those. They look at just a little bit more. You're going to be looked at a little bit more than if you have a history, but there's plenty of loans out there for them. So I would just make sure that, when you want to buy a property, you come and talk about lending first to make sure so you're not offering on a $50,000 house, because there's not a lender that will do a $50,000 house as a first time for a DSCR loan. So talk to a lender, get pre-approved first. Make sure you are calculating cash flow. Make sure the property is going to work for you. Also, make sure that the properties you're looking at, if you're going to do a DSCR loan, are rent ready. There's no health and safety concern, and that your agent's on the same page. So you're finding properties that work for you that are going to cash flow. That's going to be a good first investment. So you're not buying something and having a lot of issues. So I would say start with, making sure that you're completely pre-approved. You dialed your numbers in with the agent, the properties that you're looking for, and there's definitely there's definitely loans for the first-time home buyer for sure.
Cool. Awesome. So are you saying, if I understand correctly, for the DSCR, you don't have to have a job or any income. You could be self-employed, stuff like that. Not a problem, as long as the projected rental income or the current rental income is going to cover your mortgage and then some. But did I hear that you have to own a home already, or you have to? No,
You don't have to own a home. So we have programs for first-time home buyers and first-time investors simultaneously. So you come to me and just say you live with your parents in LA and you don't have a reason to buy a primary, we can still do a loan for you. Some of those loans require minimum. We can't go down to no minimums, which we have lenders that do that. So it's a little bit tighter on the first-time home buyer, first-time investor. Just a little bit more requirements as far as minimum loan amount, credit, things like that. But it's definitely doable all the time.
Awesome. Well, very cool. And so that's the person buying their very first property. And with DSCR, you're not necessarily wanting to target a fixer-upper, right? This has to be a property that's, by and large, kind of rent ready or very close to rent ready, where we can put a tenant in there. It's not missing, bathrooms or kitchens or drywall or stuff like that, right?
Yeah, so if you're going the DSCR route, that has to be, like you said, rent ready. It can't have any health and safety repairs needed. So let's say there's minor things that need to be fixed up. You don't got to go replace the cabinets, things like that. But if there's floorboards missing, you have mold in the basement, the water's not working, there's a hole in the wall, things like that. Yes, it has to be rent ready. These loans are focused solely on the property. So as long as the property can be rented and it is in a position to have a renter in there, then you're going to be getting cash flow from day one to cover your payment. But we also do the fixer-upper loans too. So let's say you're a first-time investor and you want to do a fixer-upper loan. We can do that as well.
Yeah. So tell me what that program looks like. If maybe I do have the 20% down, but this, a lot of investors, especially first-time investors, are going to find themselves in a spot where, I've got 40 or 50 grand. But if I put that down on a property, then I don't have any more to invest. And I don't really want to put all my eggs into one investment property. I'd rather buy something that I can fix up to either rent, refinance, or flip, get a little bit more capital to then start building my rental portfolio. So if I want to go after the fix and flip, what does that look like as far as?
So fix and flip hard money loans, typically the rates and the terms get better with more experience. But they do allow the first-time home buyer, first-time investor to do a hard money loan. You're going to have a higher interest rate. You are typically going to put a little bit more money down. How those typically look is about 15% down of the purchase price, and then they finance 100% of the rehab.
Okay.
So that's a good way for somebody that doesn't have a lot of capital to be able to cover the rehab. Then they're not, buying the house and having to go, take 10 grand out of their savings to put it in. Like I said, the terms aren't great. You're going to pay a little bit more points up front for the risk because, somebody is giving you a loan and they have no, they're going off of nothing. They're going off that you paid your, credit cards and some installment loans on time and your credit's good. And the fact that you passed a background check and you're not a you haven't committed anything, any fraud or any sort of, felonies, but that's all they're going off of. So
Yeah.
they may require you to put a little bit more down. Typically on the hard money, I would say it's around 85 loan to cost, about 15% down. Um, and you'll probably pay, a few points from the lender, a few points on the origination side for the broker. So you might pay 5 to 6 points plus closing cost, but they'll get you in the house. They'll get you in that first
Yeah.
house. And as you start to do more loans, especially with the same lenders or, as you get more experience, that rate drops. You can typically go up to sometimes 95% loan to cost, putting 5% down, financing all your rehab, if you're an experienced investor.
Okay. So those terms will get better with more experience as I
Yes.
do more
Yes.
deals. And generally, I want to get in and out of this loan in like 6 months. I'm generally not holding this because it is going to be expensive with probably renewal points and a higher interest rate, stuff like that. So I do want to either sell the property, make a profit flipping it, or refinance. And could I refinance into the DSCR product that you talked about before?
Yes, absolutely.
Okay.
So when somebody's doing a rehab loan, one of the first questions is, let's make sure you qualify for the rehab loan, but also what's your exit strategy? If you're going to sell the property, then let's make sure the rehab and everything is done by that point. If for some reason you can't sell the property or your plan is to hold it, I'm going to do a pre-approval as well, making sure that you can get into that DSCR loan. So we'll make sure loan amounts match. Credit, make sure that we can do what the end goal is ahead of time, based on all the information I have now. So you're not put in a position where you're stuck in that loan because, 11% interest rate doesn't sound too great.
Right.
And a lot of the hard money will allow you to go up to 12 months. But absolutely, yes, that's part of my first call. And, when we're in the pre-approval process is let's make sure we can put you into a DSCR loan.
Okay.
If you can't sell the property or that's your end goal is to hold it.
Yeah. So a lot of investors, I'm sure you've heard of the Burr method where they
Mhm.
buy, rehab, rent, refinance, and repeat. If they're doing this method with the hard money loan that you help them get up front, they fix it up, they rehab it, and now it's worth significantly more. Let's say we're shooting for DSCR. What are you, like 75% loan to value on those?
75% on the refinance. And
Yeah.
sometimes we can go to 80. Mhm.
Okay. So let's say we hit an appraisal that is basically 75% of the purchase price and the money that we had into the deal. Is there anything that prevents you when we go to refinance at the DSCR not to get us all of our money back out so we can go do another one?
So the max is going to be whatever the new ARV is, 75%. So we hope that when you calculated, all the rehab and everything up front, when you bought the property, you looked at the value, you looked at what the rehab is and what the ARV is. That's a really important calculation, not just to go in and just throw a bunch of stuff up, but to really make sure that you're talking with your agent and making sure that all the repairs you're doing is gonna, hit your
Right.
value.
Yeah.
Because we wouldn't want you to get another appraisal and the ARV comes in low and you can't pay it off. You have to be able to cover that.
Got
Typically, you want to make sure that the ARV is over 20% higher than your what money you have in to make sure there's room for a refinance. Typically, I don't run into a lot of this. I have had people think their value's way higher and then they didn't do the proper work and their values
Yeah.
come in short. But as long as take the ARV times 75%, if that covers what you put in and you can always get additional cash out too, then you're good. If you're short, then you're bringing money to the table.
Got it. Okay, that makes sense. Yeah, and that's where it's really important to just have an agent that can get you comps and know what they're doing when it comes to figuring out what the ARV of the property is. So that's so critical. The reason I asked the question is because I've ran into this issue with local banks, is where I'm doing the Burr method and I'm fixing it up and I hit all my numbers, but then that bank says, well, you only have $150,000 into this property, and we're only going to refinance you at 120 because we still want you to have 30 of your money in it. And it's like, well, that defeats the whole purpose of why I was doing this in the
Yeah,
first
yeah,
place.
yeah.
And they're
No,
kind of
our lenders don't look at it that way. There
yeah,
are different lenders are, hey, we can do max this a calculation of what you put in
Yeah.
plus the purchase price. If you're trying to do it, under 3 months, once you become 3 to 6 months, the lenders open up. 6 months and more,
Yeah.
it becomes, it's just an easy 75% cash out. So
Yeah.
depending on the exact calculation and how quick you're turning it around, they calculate things differently.
Yeah.
But typically they're going off of the ARV with most investors.
So yeah, so what I think is happening is when I'm working with a single institution or a single bank, they're looking at their risk. Well, we don't want this guy walking around with no money in this deal, so we got to make sure he still has some in there. And then I think what's happening with you is that you're a broker, so you're pivoting from different lending institutions. You used one institution for the hard money, and now when you swivel over to the DSCR, that's a different roof, and they're just looking at appraisal basically. They don't care how much they rehabbed and how much money went into it on this other phase. They're just looking, hey, this is worth this now. We're going to pay off this current note with the hard money and refinance them at 75%. Is that right?
Yes. Some of the lenders, if you're under 6 months or under 3 months, it's a calculation based on what you paid for it, how much rehab. Then typically the loan amount would be 120% of that, but that would be the minimum loan amount. Typically the ARV isn't even higher than that, so we typically don't run into a problem.
Okay.
So if that makes sense.
Yeah.
So sometimes they do ask for the rehab to be documented and show you rehabbed it if you're doing a quick turnaround, a couple months. But once you're kind of over 3 months, over 6 months, they're just going off of ARV.
And they're willing to go 120% of the purchase and rehab. Is that right?
So we have one lender that'll do smaller loan amounts, and if you in between 3 to 6 months of ownership, they'll take what you paid plus the rehab and then multiply that by 120%. You can't have a loan amount more than that, but typically the loan amount isn't more than 120% of your all-in money.
Right.
So
yeah, the most
yeah,
important
so
thing is, can I get all my all-in money back out? And anything above that's, of course, a bonus. But then you're leveraging more, so it's kind of a pro and con of that. Cool. Well, that's really good. So I think we covered a lot on how to get somebody into their first investment property, whether it's just a kind of a turnkey rental or something that needs to be fixed up. So let's talk about as you're scaling. And earlier you mentioned the guy that's buying his 100th investment property. What does that look like? What kind of things do you have to start thinking about when you start scaling up, and what kind of products do you have to help that investor who's maybe going after their 100th property?
yeah, so kind of how a lot of people start is just the DSCR loan, putting 20% down, just buying them turnkey. And some lenders have, like, if you've done so many loans with them, you can't use that product anymore. So I have to be strategic of, let's do loans with this lender and then we switch to this lender. Kind of internal things that I have to monitor. But as people are scaling and buying properties individually, putting 20% down, paying full closing costs on one loan, what a lot have been switching to as they start to scale is paying cash, rehab it. Once they get capital, they're paying the cash to buy the property. They're putting their own cash rehab in it. And then instead of doing that 20% down purchase and paying closing costs and then refinancing to get the equity after you fix some things, they're just doing a cash out refi and just doing 75% of the new appraised value. And they're pulling out the money they paid for the house, the rehab, and additional cash out. So that's kind of maximizing your money back. And it's just one loan. So you're paying one set of closing costs versus buying doing the DSCR loan and going, okay, I rehabbed it up in a year. You're paying another set of closing costs, doing another loan.
Smart.
So a lot that are scaling are paying cash for any sort of fix up and then doing the refinance. So that's a method that a lot do when they're scaling, and you can do them individually or you can do it as a portfolio. So I have other investors that take all the properties they own for a while. Let's say they've owned them for a couple years, and then they put them into one portfolio loan, pull all their cash out. They have one set of closing costs. If you have 30 properties, 20 properties, 10 properties in one loan, your closing costs are going to be a lot less than 10 loans, 20 loans, 30 loans. So they'll put them into a blanket loan all together in one payment. That loan to value typically is 75% at the max, sometimes 70. And so it's not a high LTV. You can't get 80 on those. Refinance or purchase typically are capped at 75.
Cool.
So they will do that method if they have a bunch, or they'll do the pay cash, rehab it, buy 30 properties if you have the capital, 20 properties, and then do one blanket loan, take it out. So in these cases, it's saving on the closing cost really is where you're saving when you need to finance a whole bunch of properties.
Yeah, that's really smart. I didn't even realize I was doing that. So, like, yeah, when I got started, I needed a loan to buy the property and refinance the property. And now today, we skip the upfront loan because we can save a lot of money by just paying cash, and it makes our refi a little bit easier. One of the strategies that I've done was, instead of paying literally all cash, we'll pay cash, but then my company will put a note on the property. And so then when we go to refinance it, instead of it being a cash out, it actually is just a rate and term. And so I put that note value as the number I want back when I refi it. And the new mortgage comes in and just pays off the note. So they write a check to my LLC. So instead of cash coming back to me, it's a little less risky for the other lender to just pay off the existing note and put their own. So we get a little bit better rate on those type of deals.
And I do have investors doing that. That you could typically go to 80% loan to value, and the rates are going to be better on a rate term refinance where you're not getting any cash back.
Yeah.
Versus a cash out refi.
Cool. Yeah, that's awesome. Yeah, so that's a little bit into the strategy there. What else did you say that caught my attention? The loan limits. I ran into this on the conventional side, where for conventional mortgages, I believe you can only have 10 of those type of loans before you run out of them. And so the big reason why everybody wants conventional loans is because you get the 30-year fixed rate mortgage. Now, I think years ago, there was no other products that really had the 30-year fixed rate mortgage. But now today, a lot of these loans that you're doing do have that, right? They have the fixed rate where we don't have to worry.
We have 30 and 40-year terms on the fixed rate.
Holy cow, a 40-year.
Yeah. So if you're doing smaller loans, if you have a $75,000 loan amount and you go from a 30 to a 40-year term, it might be like $20 difference, so on the bigger properties, it makes a difference. But yeah, we do offer a 40-year and we offer 40-year interest only.
Yeah. That's awesome.
So
now is the 30-year, is that only good for residential properties, or can you use it for commercial and apartment buildings and stuff like that?
Yeah, so 5 to 8. So 1 to 4 is kind of considered the same in our world for the DSCR. Once you get 5 to 8, the appraisals are a little bit different, but it's calculated DSCR. Once you're 8 and over, it becomes a commercial property where they need tax returns and looking at personal financial statements. But yeah, most all of them are 30 years.
Okay, awesome. Very good. And then when you did mention there, once I have a portfolio of properties, I can kind of refinance and get a blanket loan that will cut down on my closing costs and simplify things. The only thing I go to is like, okay, well, let's say I want to sell one of these properties. Is that become difficult when you have that blanket loan?
Yeah, depending on the lender. So a lot of times it's whatever value that property had when you went in. If you pulled just that property out, a lot of times you're paying 120% of that property. So you're kind of paying a penalty to take one out. What you could do is take one out, refinance the rest. But that's one of the things that, upfront talking to investors, if they're, they say they want to buy 10 properties. Hey, we can put this 10 properties into a portfolio, or we can do them individually. Some will still choose individually, pay slightly more closing cost, to do them each separately. But then they have the freedom to sell, refinance, do whatever they want. Because let's say a couple of those properties, they got for a really good deal. They're gonna rehab them, and then they're gonna get a lot more money out. Once it's in that portfolio, you can't change things. And so that is one thing I make sure if I'm doing a portfolio, hey, I just want to make sure that if you pull it out, here's the terms, here's the risk. Make sure if there's any you think you might sell, if there's any duds in the portfolio, if you bought them from one seller, anything like that, maybe leave that one out. And also we do a lot of non-recourse term blanket portfolios, which let's say somebody has 40 properties, it's non-recourse. It's a 5 or 10-year term. If you pay that off early, the interest, the prepayment penalty is really high. You're paying basically the interest for the whole loan if you pay it off early.
Tell our listeners what the non-recourse means. Not everybody.
So non-recourse means if somebody's closing in an LLC, basically they're coming after the LLC and they're not coming after a guarantor. So when you do most all DSCR loans, you have, let's say you want to, you have your company.
Yeah.
We'd pull David's credit. He would be the guarantor of the loan. And, if you stop making payments, they come after your company, they can't get anything, they're going to come after you personally. And if you
Right.
default on the loan, they can report it to your personal credit.
Sure.
In non-recourse, they're not coming after anyone singly. They're coming after unless there's something fraudulent that happened, in the loan. But other than that, it's just the LLC. So they're coming after your LLC and it stops there. So it's a layer of protection
Wow.
for the members of the LLC. It's not going to report to personal credit ever. It's not tied to you personally whatsoever.
I didn't even
So
know
those
it's
products,
possible to
those
get,
products, those products typically only exist. There's a couple lenders I work with, and they're all term products, and they're, quite a bit of properties. Minimum loan amounts 500,000, and typically a lot of them are doing 30, 40 properties. They have, just different requirements to meet. So they'll have you create another LLC, and then your LLC will own it, and then it's owned by you. So there's layers of protection. But yeah, that's a benefit of not coming back. Let's say something happens, they're not coming after you. But also, if you want to pull one of those properties out or pay it off early, you're going to pay the interest for the entire loan to get out of it. So
oh, wow.
The rates are better and the terms are better, but you might want to make sure you're staying in it for the long haul if you're doing it.
Okay. Got it. So that's really for investors that have kind of scaled up a long-term rental portfolio. They're in a position where they can take out $500,000 and still have lots of equity left in the portfolio. And they have no intentions of selling or refinancing.
Yeah.
They want to get locked into something that has non-recourse so that, if something happens, the lenders can't come after them and their family. They just take back the portfolio if something happens is the worst case, right?
Yep.
Cool. Well, that's good to know. Awesome.
And those lenders they're it's not easy to do those loans. You have to have a decent amount of properties. You have to have higher loan amounts, to meet those requirements. So if somebody just wants to buy one house, you can't just get a non-recourse loan.
Yeah. You gotta have a personal guarantee. Yeah. That makes sense. Well, very good. Well, cool. Well, anything else that you feel like you'd want to share for the investors or the agents that are listening?
I think a lot of investors come over and they think they know everything themselves, and they think they, know the values, and they've dialed things in. But what I found is the ones that work with agents, I see a lot better results, because a lot of them will say, I want to refinance, I think this property's this, or I want to buy this property off market. And they're running comps themselves, trying to figure it out. And sometimes they get themselves in situations because they just don't know the proper way to, calculate comps or figure out value. And I think also too, I've had a lot of situations where people want to just represent themselves on the buyer side, and they want to buy 10 properties from a seller, and then they get into the weeds of trying to navigate inspections, trying to navigate repairs, trying to navigate negotiating. And I have some investors that every time they come unrepresented, it's just a disaster. And a lot of times the deals fall through, they don't get things. So I would say to investors, find yourself an agent, a buyer's agent, and it's worth the money that's to pay, because it's going to save you and it's going to make everyone's life easier, because they're the expert in that. And most new investors or even experienced investors just don't have those skills to negotiate all the repairs, negotiate the prices, deadlines. They just think that dates don't mean anything on a contract, and they can just do whatever they want. So that's another thing I highly suggest is if you're a new investor, an old investor, find an agent you like and just work with an agent on all your deals. The price you pay for commission is worth, everything else, not losing relationships and going through the headache of everything that they handle.
Yeah, I love that. That's really good. Yeah, because I experienced that myself when I wanted to get into investing. I had my license, so I was like, well, I don't need to hire an agent. I thought I knew everything because I had done deals as an agent before, and now I was investing. And exactly what you said happened to me. I made all these mistakes. The deal was blowing up, and I spent way more money than I should have. I lost money on my first deal, and had I just had another set of eyes there that had some more experience and a different viewpoint, they could have pointed out all of these mistakes I could have avoided. And that's what we do for people today. And yeah, it's well worth the 3% or whatever that you might be paying to have somebody ensure that you're not going to lose a lot of money investing in a deal, and all the numbers are going to turn out the way that you're expecting. So I'm glad you brought
Yeah,
that
I've
up.
had a few deals recently, so it's high on my
Yeah.
brain deals that aren't going through because, it's they're not meeting deadlines. They're not,
Right.
they just think they know everything. And so I told them, next deal you come with an agent. It's gonna make
Yeah.
your life easier, my life easier, everybody's life easier. Because you think you're an expert in it, but you're really not. And there's so
Yeah.
many things that are missed, that's what an agent's for. So I suggest all agents come with a buyer's agent.
Yeah.
I
And
mean, all investors
so
come with a
do it.
buyer's agent when they're putting things under
Yeah.
contract.
And I actually like it when there's agents on both sides. It makes it
Mhm.
so much smoother when
Communication.
there's just that buffer between the buyer and seller, because it can get emotional real quick when the buyers and sellers start talking to each other, and one little comment can blow the whole deal up over nothing, and it's something that, yeah, the agents sometimes go, uh, yeah, sometimes are not valued as much as they should be. And I think there is a lot of value in keeping the deal together and negotiating and making sure everybody's on schedule and getting to closing. So,
And I think one more thing with DSCR loans is if you know you're doing a DSCR loan and you have an agent, make sure your agent's talking to the loan officer. They know exactly what a DSCR is, what the property requirements are, because there's a lot, when the appraisal comes back and they're like, well, the seller's not fixing anything. And it's like, well, so I think that's important
yeah,
just to know as an agent, as an investor, what has to be done. And when you're going through inspections, making sure that if you're going to move forward and there are repairs that the seller is on board, because we run into that a lot where the seller refuses to fix anything. And everybody knew going in that if this is a DSCR and they call out a repair, you can't get a loan.
yeah,
And that's a helpful point of if you have the cash to pay the cash, because then you don't have to worry about little, health and safety things that the appraiser calls out. You can
yeah.
just pay the cash, fix it yourself, and then and do the refinance and not have to deal with those, little repairs.
Cool. So that's good to know. So the appraisal on a DSCR may have a little repair list that says, hey, these need to be done before. Okay.
Yeah, so on DSCR it has to be rent ready, can't have health and safety. So if we get an appraisal that's subject to, anything after that subject to line on the first couple of pages has to be fixed no matter what. If they take a picture of a boarded up window, has to be replaced. That's a safety issue. If they take a picture of mold in the basement and the standing water, if they take a picture of a giant crack down the wall and say, hey, we need a foundation report to show that there's no structural, you got to go get the foundational report.
Okay.
So there is a lot of, just making sure the seller knows that,
Yeah.
if there's any health and safety issues, and the inspection that should come up. And it's one thing is I would tell nobody to go through the loan without an inspection. You just don't know,
Yeah.
don't go
Yeah.
through a sight unseen and don't have an inspection, try to walk the property first. But if there are health and safety, run by the lender and just say, hey, this is a potential issue. Is it going to get called out? I've
Yeah.
seen thousands of appraisals, so I can usually say, I'm sure they're going to call that out. Sometimes they're not going to call it out. But just knowing that if health and safety are called for any DSCR lender, it's a standard across the board. Health and safety has to be fixed prior to closing if the appraiser, if you get an appraiser that kind of just doesn't say anything about it, then you're okay. But if they take a picture of it, even if it's not subject to, even if it's as is, I think that's a misunderstanding is if it's an as is appraisal, they just think everything's good. We're kind of in between conventional and FHA when it comes to what the requirements. It's kind of like a middle of the road. It's not as lax as conventional, but it's not as, you have to fix every little thing like FHA. So just
Cool.
knowing that if the appraiser takes a picture of something, you better have it fixed or a reason of why it's not, why it shouldn't be fixed or why it's not.
And that has to be fixed before closing, right?
Yes.
So you
Yeah,
got
there's
to
no
get this,
extra
yeah.
holdbacks.
So you got to get the seller to buy into that. because
Yeah.
they're going to be owning the property. So whether you're paying for it or they're paying for it, um, yeah. So it sounds like if I'm doing DSR, I definitely want it contingent on that appraisal, because if anything
Yes.
comes back there, now I can bring it back and say, hey, appraisal says we got to fix this window before closing, and then you can then negotiate who's going to pay for the window. But at
Yeah,
least,
a lot of times the sellers will, especially a lot of these investors, are I'm not fixing a thing, it's as is. But if anybody wants to get a loan, they're gonna, let's say buyer number one, not gonna work out, they terminate, they don't want to fix it. Buyer number two wants to do a loan. It's gonna be a rat race of the same thing because all lenders look at it the same way.
yeah,
The only buyer that they're getting away with not fixing it is a cash buyer. So
got it.
yeah, just making sure the seller's on board. If the seller says 100% not fixing it, then you better make sure that you have an inspection and there's no health and safety issues, because a lot of sellers push back and then a lot of them fall into it and say, okay, that's fine, I'll fix it. Or if you want to come over and fix it, and we don't care who fixes it,
Yeah.
somebody has to fix it.
Yeah, so it's important not to write like a no contingent contract if you're really needing a DSCR loan to pull it off, because there is something that could come back that needs to be fixed. So we need to have either the inspection contingency or an appraisal contingency, something like that, to cover your bases. That's really good. Awesome.
And then also, if somebody comes back with a bunch of repairs, we can easily flip it to a hard money rehab loan. If you didn't think there was that much needed and realize there's a lot more needed once,
Yeah.
You got inspections back, we have that ability just to say, okay, now we have another type of loan that can still help you out.
Yeah, that's kind of what I want to bring up here in closing. It was that Holly does them all, and I think one time you mentioned to me, like, if there's a loan out there, you can do it. So tell people just in closing, what all kind of loans that you help people do, and then also where to find you and how to reach out to you.
Yeah. So I do any and every type of loan, conventional, FHA, VA, HELOCs, SBA loans, apartment buildings, commercial, you name it, mobile home parks, and anything that there's a loan for a property. I can do it, or I can find someone to do it. Work with about 250 plus lenders. My niche is the investor world, so DSCR loans, fix and flips, and blanket portfolio loans. And you can find me online at dscrqueen.com, or DSCR Queen on all my handles.
Nice.
And my name is Holly Niemeyer, and my cell phone is 513-226-3739, and Niemeyer at nexalending.com. Reach out to David and he can get you my contact information.
You bet. I love the handle DSCR Queen.
Yep.
Bet nobody had that one yet. That's awesome.
Yep, nobody had it.
Cool. Well, I'll be following you on there too. And thank you for being a guest on the show today. We love hearing from you, and we'll continue to use you and Nexa in our business as well. Thanks for being on the show.
Thank you. Thanks for having me.
Yep.